Our mission is to improve the quality and effectiveness of fiscal and monetary policy and public understanding of it. I think we all understand, and if we didn't, we learned during the Great Recession how important monetary policy is. It seems to me that in a democracy, monetary policy is too important to be left only to economists. And that's one reason why I'm very pleased that we have Dan Tarullo here with us today. Dan is a Boston native, a graduate of Georgetown University of Michigan Law School. He's worked in the Justice Department, the Commerce Department, the State Department, Ted Kennedy's staff, and coordinated international economic policy in the Clinton White House. He's practiced law. He's taught at Harvard Law School and Georgetown Law School, and he tells me he will return to teaching in January, but he doesn't yet know where, or if he is, he's not telling us where, so that'll be the mystery. Let's see if someone can pull that out of him. Dan was an early supporter of Barack Obama, which doesn't seem particularly courageous in hindsight, but at the time, it wasn't what everybody who had been in Democratic policy circles was doing. And at the beginning of President Obama's term, he had nominated Dan to be a governor of the Federal Reserve, a position he held from early 2009 until just recently. Dan's in one way, you might say Dan is responsible for Janet Yellen, in which I mean that I discovered that since there was no vice chair, Dan was the governor who swore in Janet Yellen when she became Fed chairman in 2014. Now, of course, Dan's background is in financial regulation and studying banking law, and that's what he spent most of his time doing at the Fed, and that's for which he's most known. But today, he's not going to talk about that. After all, it is the fact that all 7 members of the Federal Reserve Board, whether they're economists or not, whether they're assigned responsibility for banking or not, have to make decisions on monetary policy. And the same goes for the 12 presidents of the Federal Reserve Bank, some of whom are economists and some of whom aren't. So Dan is going to talk today about really 2 things. One is about what's it like to be a non-economist on the board of the most powerful economic institution in the world. And secondly, some of his observations about the policy questions that were confronted by the Fed when he was there, and in fact continue to confront the Fed now in an era of unusually low inflation. Dan will speak, give some summary of his remarks, the longer version of which is posted on our website. Then I'll be joined up here with my 2 colleagues from Brookings, Louise Shaner, who spent 20 years on the staff of the Federal Reserve, and Don Cohen, who served both on the staff and as vice chairman of the Federal Reserve Board. So with that, Dan, the podium is yours.
Thank you, David. It's good to be here this afternoon. So as David said, I was obviously a non-economist coming into the Fed with a specific academic background, specific expertise in financial regulation. While, like almost everybody, I had taken the basic economic courses in college, that was quite a while ago, and had picked up some macroeconomics along the various policymaking jobs that David recounted. I certainly was not immersed in monetary policy when I arrived in 2009. And obviously that was to some degree a handicap, to some non-trivial degree early on, I think. But as I'll try to explain, it, I think, turned out over time to be something of an advantage in one respect as well, because once I had had an opportunity to dig into some of the concepts and theories around which monetary policy decisions were being made, I might have had a slight advantage in seeing where some traditional correlations were breaking down, some traditional assumptions that would be shared, at least in a general sense, among the economists at the FOMC might not be as airtight or as powerful as they once had been. So in the paper that David mentioned, it's now been posted on the Brookings website, I try to explain 2 things I learned during my time in the Fed. One is a substantive monetary policy point, which is that we do not at present have a theory of inflation dynamics that works sufficiently well to be of use for the business of real-time monetary policy making. And I emphasize that, real-time, meaning at particular meetings, do you stay where you are with the federal funds rate? Do you raise it or do you lower it? Second is a sociological, more of a sociological point, which is an observation of the dynamics of my economist colleagues, both on the FOMC itself, but also the excellent staff at the Fed. And that is that many, although by no means all, good monetary policymakers, even really good ones, are maybe a little bit more attached to some of the concepts and theories that are not as airtight or is not as useful as they might once have been. And the reasons for that and the implications of it, I'll try to say a little bit more about later. But I want to say right at the outset, this is the furthest thing in the world from an emperor has no clothes kind of talk. I learned an incredible amount from my colleagues, both on the staff and on the FOMC. I mean, first and foremost from Ben and from Janet, and more recently from Stan, but from others as well. And what I often found my role being is one who kind of in a law professor, sort of a nudgy law professor way, would begin asking questions, but instead of getting resistance, actually it would sometimes provoke what I at least thought were very productive conversations. So it's not as if the economists were sort of closed ranks, but I do think the sociology of any group that has its own learning, its own traditions, is something we need to take account of when we are formulating the composition of any policymaking institution. I'm going to, substantively, I'm going to focus mostly on inflation expectations, because I think that has become a very important concept in thinking about inflation dynamics, one where I ended up having an awful lot of questions about its relative utility for real-time policymaking. But I wanted to start off, and there's way more on this in the paper than I'm going to use in my oral words, but I'm going to start off talking about three of the variables that are projected in the summary of economic projections, which each participant in the FOMC does for every other meeting, 4 times a year. Now, I learned quickly after getting there that while the dual mandate in the Federal Reserve Act, which instructs the Fed to achieve price stability with maximum employment, refers to two things which are very much observable, employment and inflation. Most important considerations in monetary policy are unobservable. And when you stop and think about it, that's perfectly appropriate, because when you're making policy, particularly something like monetary policy that has a lag in its effectiveness, you need to be concerned not so much with where you are today, but where you're going to be several months or quarters from now. And thus, by definition, the board and the FOMC as a whole need to be looking forward. And of course, in order to look forward, people look for concepts that help them make those kinds of projections. Now, the three variables that I'm referring to are potential GDP growth, the natural rate of unemployment, and the neutral real rate of interest. Technically, those are not called for projections in the SEP. Technically, what the SEP asks for is the values to which GDP growth, unemployment, and the federal funds rate would converge in the longer run with appropriate monetary policy and no further shocks. But without getting into the details of it, workably speaking, those three concepts that I just identified are really quite similar to what's being asked for in the SEP. Now, the fourth variable that's asked for, the longer run variable, inflation, is not really a variable. The FOMC has adopted a 2% target. Everybody dutifully puts in 2% as the long run variable for every SEP projection. So it's really, you can almost think of it as more of a constant or more of a independent variable, with the other three being relevant to policy making. Now, these three variables are not simply unobservable directly, as, for example, productivity or savings rates would be, but they're not data at all, right? They're concepts which can be translated into concrete values only through estimation, and judgment. They're determined by fundamental forces that are at work in the economy, such as long-term fiscal situation, productivity, some of the other things which people have talked about as shaping the potential for the economy more generally. When I first got to the Fed, and the first time I was asked to do these, we didn't have the neutral rate of interest in 2009, but I was asked to do the others. I was a bit perplexed because I sort of wondered, this may be where you really need technical PhD-like training in order to make these kind of projections, because I, for the life of me, couldn't see my way through everything that was happening in the economy and that might be happening subsequently in order to project where unemployment, GDP growth would converge or would end up some years down the line. Well, it turned out that I wasn't the only one who had difficulty doing this. And indeed, if you look at the progression of those longer run projections by the FOMC from the 2009-10 period, you'll see exactly how much they've changed. The median longer run unemployment rate projected by the FOMC has dropped more than a percentage point from the 5.5% projected in late 2010. The median longer-term GDP growth rate has declined almost a percentage point from the 2.7% projected at the same time, a much more dramatic change in relative terms, by the way. And with R star, the median projection of the longer-run federal funds rate has come down from the traditional 4% of 5 years ago, which is basically 2% on inflation plus a 2% R star, the neutral rate on top of anticipated inflation, to about 2.75% today. So you can see there's been a lot of change, and at one level that's a very good thing. It shows that FOMC members have not gotten stubborn about their projections when reality has kind of undermined initial expectations. But one thing that I did observe or wonder about over time is how much impact the whole exercise and the assumptions that lay behind it might be having on decision making. The concepts themselves, obviously, necessarily involve hypotheses about the relationships of economic variables to one another. Most importantly, for monetary policy purposes, the relationship of employment and output to inflation. These concepts are frequently explained or even assumed to define an upper bound to growth and a lower bound to unemployment, beyond which inflationary pressures are somewhere between likely and sure to take hold. So there's a kind of, you'll hear echoes of a Phillips curve relationship, right? A relationship between slack and inflation. But as everybody in monetary policy knows, the Phillips curve has had a much flatter slope for the last 20 years or so than it did when it was originally derived, first by Professor Phillips for Australia and then later adapted for the US. Now, this didn't matter particularly, I don't think, 4 or 5 years ago. Everybody's assessment of the gap between the natural rate, wherever they thought it was, and the actual rate of unemployment was broad enough that even if you were operating on a kind of Phillips curve mentality, you weren't going to see a need for tight monetary policy tightening. But it may have begun to matter more maybe like 2 years ago as we got closer to, and then for at least some members of the FOMC, overshot what they believed the natural rate of unemployment was. Because over time it seemed to me that some economists, at least, on the committee and elsewhere, were implicitly assuming a stronger correlation between declining unemployment and rising inflation than the quite attenuated relationship that had been well documented by economists, by academic economists, for more than 20 years. Nearly everyone shares the intuition about the directional relationship between inflation and unemployment that's embedded in the Phillips curve, but that intuition just isn't very much help in making policy decisions on a meeting-by-meeting basis. So what I observed was almost a paradoxical coincidence of intellectual doubt and extremely well-informed and well-read intellectual doubt on the part of some people within the Fed and outside it, I should say, on the one hand, but on the other hand, a kind of almost instinctual affirmation of the utility of these unobservables, of expected GDP trend growth, of the natural rate of unemployment in their policy making. And in the absence of another theory that can explain the behavior of inflation and thereby guide policy making, I suspect that at least some economists are reluctant to let go of an approach that uses the natural rate and that assumes perhaps more robustness of the Phillips curve than, again, analytically and intellectually is known to be the case based on the research that's been done. And I think this is more likely to happen when the basic relationship implied by the model continues to seem correct, but the coefficient is either weak or in doubt. But of course, it's the coefficient which is most important for real-time policy making. When do you raise rates? If you just have this general sense of, well, yeah, slack is removed from the economy and other things being equal, that's probably going to start putting pressure on inflation at some point. That's a framework within which you can start thinking. But if the coefficients for the more precise relationship between, say, unemployment and inflation or other variables are more in doubt, then you have less guidance on a meeting-to-meeting basis, which, to get back to my theme, is what's most important for real-time policy making. As Jim Stock, my go-to econometrician, and Mark Watson noted in an article they wrote in 2010, the history of the Phillips curve is one of inflation forecasting in which apparently stable relationships fall apart upon publication. So this is a backdrop within which, sort of I saw more general thinking about monetary policy. It was almost as if the SEP kind of encouraged you to think in those terms. The people on the FOMC are too smart to just, in a kind of mechanical fashion, think in those terms. But I do think it had some impact, as I say, a couple of years ago on people, the expectations of some people as to when and where inflation might start to rise. So now I want to turn to inflation expectations. This is a different kind of unobservable. It's hard to observe inflation expectations directly, to be sure. But unlike observables like the natural rate, unobservables like the natural rate of unemployment, expectations are not just a factor that helps determine the path the economy will take with a given monetary policy. They're believed to exert a direct effect on the inflation rate, and this is very important, to be significantly within the control of the central bank. After the early 80s economic shocks seemed to, after the early 80s, when you had kind of a breakdown of some of the traditional assumptions about the relationship between unemployment and inflation, we had stagflation. Economic shocks of all sorts seem to affect actual inflation less than before. And so the hypothesis that gained a lot of traction within monetary policy circles was that economic actors now believed inflation would be less volatile because of the action of the Fed and other central banks around the world in the late 70s and early 80s in taming inflation. So we got expectations augmented Phillips curve, and we had that phrase echoing through the boardroom in the halls of the Federal Reserve, well-anchored inflation expectations. That was one of the phrases that jumped out at me early in my time at the Fed. They're almost a kind of talismanic invocation of well-anchored inflation expectations. So this was my experience. There was I said, okay, I had some knowledge of inflation expectations, but it was clear to me that I didn't understand the potency that they were presumed to have in anchoring inflation. And so I dug in a good bit more, found there were some things I didn't understand, but that actually there were a lot of gaps in theory and even more in what we'd need to know about inflation expectations in practical terms to make the concept practically useful for, again, meeting-to-meeting policy making. So this is where my legal academic background actually resonated a bit, because you have this experience in particularly the first year of law school where you'll read some case and there's a doctrine that's stated there and you kind of puzzle over it and say, man, I don't understand this. I must not quite be getting it. And so you wrestle with it for a while. You dig into it. You usually learn that there were some things you didn't understand, but then when you go into class the next day or the next week, the brilliant law professor shows you that actually the doctrine is not all that coherent or convincing after all, and that there are some real problems with it, but that it's the best the courts have been able to come up with. That was a little bit my experience with inflation expectations. So I understood the appeal of inflation expectations, the notion that, well, we had this experience, inflation has been more stable since. It appears as though market actors, consumers, businesses, other economic forecasters are all more convinced that inflation expectations will be stable, and indeed it appears to have been the case that inflation was stable for quite some time. So that you can understand the appeal of the theory, but I found over time, and again, this is not news to monetary policy economists, and some of what I found was based on them explaining it to me when I asked them more questions. I think there are some fairly basic issues. First, how to measure inflation expectations. Measurement problems are pervasive in economic policy making, but I think they're more challenging when you do, for example, surveys in which people are asked to self-report expectations. Secondly, and this begins to become more important, what in concrete terms is the mechanism by which expectations, apart from the measurement issues, influence behavior in setting or accepting a price or wage or investment return? This is where I think a convincing account of how it actually happens it has been formulated. How is it that if we stipulate that consumers have a certain expectation about inflation, which is a bit of a heroic assumption maybe, but if we stipulate it, how does that translate into actual price or wage behavior? I think we can all agree that it surely should be a factor, but a factor or something influencing people is quite different from stipulating a pretty robust mechanism that helps keep inflation stable over time. This view was reinforced when I would have discussions with business people, and I'd basically ask them, so tell me about how you go about setting prices. And oftentimes, those discussions, since I was no longer in the antitrust division of the Justice Department, I think I probably got a fairly straightforward answer. And those discussions often, you wouldn't hear anything about inflation expectations. And indeed, I often realized that a lot of businesses were a little bit more backward-looking in setting prices. What costs had they already incurred that they needed to cover? And when they were forward-looking, they tended to articulate it in terms of what will the market bear. Now, again, you can tell a story as to how some sense of expectation about inflation does matter to people. But that's a lot different from a well-specified theory as to how expectations translate into behavior, which in turn translates into a particular level for inflation. Third, and in some sense most importantly, how and why do expectations change? How do they become unanchored? And how big a change is needed to affect inflation? Here again, there's lots of work that people have done to try to answer those questions, but I don't think or at least now I don't think we're close to something that's like a consensus working notion of how those expectations changed. Remember, expectations, certainly consumer expectations and to some degree market-based expectations, have been at the low end of historical ranges for quite some time, which has caused some people to wonder whether actual inflation may be affecting expectations as much or more as the other way around. That is, instead of saying, well, people know you're going to get back, 2% is the place, and therefore we're kind of anchored around 2%. Instead, if inflation stays well below 2%, so the concern goes, then the expectations may actually begin to pull inflation down. Whether or not that's right, I think that's part of the debate that's going on right now. The key point, though, is there's not, I think, a reasonable working theory for how the expectations would change, even though there's lots of efforts to start developing one. So I was and I am uncomfortable with putting so much weight on a concept that is under-theorized and it's empirically really quite hard to pin down. And I should say, although that my concern has been manifested during a period in which, I worry that, past period, when I was on the Fed, that inflation was persistently under the 2% target, you've got to have the symmetrical concern as well. If we were in an environment in which there were things going on in the economy which would reasonably lead one to believe that there might be significant upward pressures on inflation, I don't think one should have too much confidence that well-anchored inflation expectations would keep inflation around 2% instead of it overshooting. So after my time at the Fed, and actually well before that, my conclusion was that there's not really a well-elaborated and empirically grounded theory that explains contemporary inflation dynamics in a way that's useful to real-time policymaking. It's not so surprising, really. I mean, forecasting is notoriously difficult, with the difficulty increasing exponentially as one's forecasting horizon lengthens. And I think these difficulties are only compounded when the economy is changing in significant ways, even as one's trying to make policy. So what implications do I draw from my experience with the unobservables and with the absence of a working theory of inflation dynamics? I'll suggest three, one at some length, the other two very briefly. First, I think we need to be paying more attention to the observables. In recent times, this has meant, to me, placing greater emphasis on actual observed inflation, as well as a broad array of observable economic factors that may be determining inflation in this specific context. That doesn't mean you have to get to 2% before you do anything, but I think it does mean that one wants to see non-transitory movement in the direction of the target to a greater extent than if you were confident about the coefficient that represented the relationship, say, between slack and inflation. Now, I should make the point that I found it useful to have the results of several models as a point of reference in thinking about my own policy position. I mean, the virtues of modeling are very real. They force you to specify your assumptions. What are the causal relationships which you think are at work? And what I was saying earlier is I think this kind of leaves some economists a little unanchored when the model doesn't seem to be giving them quite what they need. Those expectations augmented Phillips curves that seemed to work pretty well pre-crisis broke down in the crisis. So there isn't the model there that seems to be working, and yet modeling in a conceptual sense is still a very valuable exercise. And as I said before, I think the problem lies more with the coefficients than in the concept. The direction of the economic variables predicted by the model is often convincing, but the idea that we know pretty accurately how much and how quickly a change in one variable, like unemployment, will affect another, like inflation, is not. Hence the limitation on the utility of the models for deciding when to change the target rate, as opposed to, if I can put it this way, telling you, okay, you should now be in a mode where that is what you're thinking about. So in practical terms, I think it all argues for using concepts like the Phillips curve and inflation expectations as directional guidance, but relying more on observed indicators in deciding on monetary policy in real time. John Faust co-authored a paper that was given at Jackson Hole, I think 2015, in which he ran through a lot of the other factors that may be affecting inflation that may dominate, the more traditional slack or expectations kinds of explanations. What I characterize as a pragmatic approach shouldn't be understood as simple reliance on your gut, much less on ideology. Far from it. It suggests instead a careful analysis of the myriad of factors that may be holding back or pumping up inflation within the broader but less determinate relationship defined by an inflation-augmented Phillips curve. It also seems to me that we should be, as I said, placing more emphasis on actual observed inflation rates as opposed to assuming we know where they're headed based on past correlations. Now, it's likely and probably unavoidable that in the absence of reliably precise coefficients, policymakers will to some extent act on predispositions. And I think all we can ask is that they remain data sensitive, open to adjusting their views, and transparent about their reasoning. And I should say that I think recently the FOMC as a whole has been moving closer towards that kind of position de facto. The sizable markdowns in R-star and the longer-term expected unemployment rate reflect the reassessment of a range of factors affecting those variables. And I think the behavior of inflation this year in particular has prompted some of that reconsideration. When I had written this paper by the time Chair Yellen gave her speech last week, but I thought the speech was both an acknowledgement of the gaps in everyone's understanding of inflation dynamics and an example of analysis that took careful account of the configuration of economic factors currently affecting the inflation outlook, although expectations continue to play an important role. Whether you agree or disagree with her conclusions, I think her transparency in explaining her thinking is laudable. And of course, it becomes even more important in a context in which you don't have a model or a correlation with a reasonable size coefficient that allows you to use that as your benchmark. So let's see. I think I'm going to skip the other two implications because that's the most important, because I want to turn, I just end by saying I think it's, I'm going to turn to the institutional stuff in a second, but it is worthwhile for economists to continue working to try to establish useful coefficients, even if they turn out much of the time to do a better job of describing what has happened rather than what will happen. Because I think at the very least, elucidation of the relationships that have prevailed in the recent past can help place present policy-making decisions in a richer context, and at least some of those efforts may prove to have value beyond the purely heuristic. Now, what do my views imply for the makeup of the FOMC, for institutional issues? Well, first, it must be obvious, I think it is a good thing, very good thing, to have some voices from analytic traditions other than macroeconomics. Needless to say, that doesn't have to be legal academia as the source of that different analytic tradition. In fact, I think other specialties within economics can provide a very useful complementary perspective, particularly there because if you're a labor economist or an international economist, you may have a bit of an outsider's perspective on the inside baseball of the macroeconomists, but you've also got some of the technical training that allows you to maybe take it a level or two deeper. I also have long thought that somewhere in the FOMC, we ought to have someone with a background who has been in non-finance business, who has been in some part of the real economy. I met these people, often the chairs and the vice chairs of the Reserve Bank boards, and then other groups that would just come in to make presentations to the board. And there were a lot of very perceptive people who had been in business quite a while and who read what was going on in the economy, I think, somewhat different from the way our analysis at the Fed went. And I think oftentimes we're just, because of their experience, we're just a step or two ahead of the data in seeing where things were going or how to interpret it. And I really do, I don't understand why we don't have someone like that, but I think we should. Having said that, the weight of the committee should remain, in my view, with those who have been long immersed in monetary policy, so long as the individuals in question are not enthralled to models. Now, why do I say that? Well, my experience with my colleagues when I pushed at concepts was, as I noted earlier, that they would often actually reinforce my views because they knew the literature and the history so well. I think economists can both fall into their own models and become a little bit more attached to their own models than we might think warranted. But who are the people who undermine those models? They're other economists who are the ones who have the technical wherewithal to say, here's what's not working and why. So paradoxically, the absence of a working theory of inflation dynamics only reinforces my view. If there was something like a Phillips curve that was providing reasonably good guidance on monetary policy decisions, then one or more capable non-specialists would have a sound starting point for monetary policy. But in the current circumstances, I think it's even more important to have people who can draw on a deep knowledge of the history and theoretical evolution of monetary policy in assessing contemporary economic conditions, and who have the competence to evaluate the continuing efforts to devise correlations and coefficients that might inform contemporary decisions. So I do, as I say, the real experience that I had was one of a bit of an outsider from a different analytic tradition, without all the technical background necessary to make some forms of critique, but who knew enough and spent enough time to be able to ask the slightly uncomfortable question. But the thing I want people to come away with today, so to some degree, yeah, I thought there was maybe a little bit of, a little bit too much attachment to things that were perhaps not as useful or powerful as they were assumed to be. But the most important part of the story is that when that conversation got going, it is the same people, the macroeconomists. It's people like Ben and Janet and Stan and Don, who's sitting in front of us, who I think are as well equipped as anybody to critique what has been the received wisdom and to be able to draw on a very rich background to know, yeah, this has happened before, this hasn't. Here's something that may be relevant in thinking about what is happening now. And of course, to have the technical competence to evaluate not just what the Fed staff is doing, but all that literature that is coming out in SSRN and the old NBER yellow books, which are now just online. So that's where I end up. On the substance, I think we're in an interesting position right now. What it makes me feel institutionally is that macroeconomists are more important than ever, those who are sort of self-critiquing. But I do think that, as with almost any group, it's useful to have some outsiders who take the time to dig in to the learning, but who still bring a different perspective to it.